Here's what's really going on. Silver just crossed $79 an ounce. And if you think this is just another commodity rally, you're missing the entire picture. We're watching the early stages of a systemic shift that's going to expose every assumption the market has made about tech dominance, dollar supremacy, and the artificial hierarchy that's been built over the last 40 years. The metals aren't rising because of inflation fears or industrial demand stories. They're rising because the foundation underneath our monetary system is developing stress fractures that can't be papered over with another round of quantitative easing or forward guidance. The establishment wants you focused on quarterly earnings reports and the latest AI breakthrough. They need you believing that innovation and digital transformation are the only metrics that matter. Meanwhile, physical assets are screaming a completely different message, and the divergence between what silicon promises and what silver proves is becoming impossible to ignore. This isn't about being anti-technology or some romantic return to the gold standard. This is about understanding what happens when debt saturation meets resource constraints in an economy that's been financialized beyond recognition. Let me walk you through why this silver surge matters more than the latest semiconductor stock hitting all-time highs, and why the relationship between precious metals and the tech sector is about to become the defining investment narrative of the next decade. Silver's move to $79 didn't happen in a vacuum. Look at the timeline. We've had 15 years of central bank intervention creating the most distorted asset pricing environment in modern history. Zero interest rate policy, the negative rates in Europe and Japan, quantitative easing programs that expanded balance sheets from billions to trillions. Every one of those policies was designed to funnel capital into risk assets, specifically equities, and more specifically into the growth and technology sectors that benefit most from cheap money and long-duration return profiles. The game was simple enough. Suppress real rates, make savings accounts and bonds worthless, force everyone into stocks. Tech stocks became the ultimate beneficiary because their valuation models thrive in low-rate environments. When you discount future cash flows at near zero rates, suddenly a company that might be profitable in 10 years looks incredibly valuable today. That's how we got trillion-dollar valuations for companies burning cash, how we justified price-to-sales ratios that would have gotten you laughed out of the room in any other era. The Fed created a technology bubble by making the alternative to stocks so unattractive that there was nowhere else to go. Consider this for a moment. The same policies that inflated tech stocks also systematically suppressed commodity prices, and precious metals specifically. It wasn't accidental. When central banks want to maintain confidence in fiat currency, they need commodities to look weak. Gold and silver rising aggressively sends a message that paper money is losing purchasing power, that the monetary authority has lost credibility. So we saw coordinated efforts through futures markets, through tactical sales from central bank reserves, through propaganda campaigns convincing investors that metals were barbarous relics with no place in a modern portfolio. They almost succeeded. For years, the narrative held. Tech was the future, metals were the past. Bitcoin became digital gold, rendering the physical versions obsolete. Portfolio managers abandoned commodity allocations entirely, chasing the momentum in FOMC stocks and their countless imitators. The financial media reinforced it constantly. Every guest on financial television had the same message. Growth stocks are the only place to be. Value is dead. Commodities are finished. But here's what they couldn't control. They couldn't eliminate the fundamental difference between financial assets and physical assets. Financial assets are claims on future productivity, promises backed by institutional credibility. Physical assets are tangible stores of value that exist independent of anyone's promise. When you own a share of stock, you own a legal claim that's only as good as the legal system, the accounting standards, the regulatory framework, and ultimately the currency in which it's denominated. When you own an ounce of silver, you own a physical object with properties that don't change regardless of what happens to governments or banking systems. That distinction didn't matter during the everything bubble. When asset prices only go up, when central banks guarantee they'll backstop any decline, who cares about the philosophical difference between paper and physical? Everyone became a believer in institutional permanence. The Fed put was real. The printing press was infinite. Modern monetary theory suggested we could finance anything forever without consequences. Silver hitting $79 is the market's way of saying that belief system is breaking down. Let's dig deeper. The industrial narrative around silver has always been the cover story. Yes, silver has applications in electronics, solar panels, medical equipment. Yes, industrial demand creates a supply-demand dynamic that's different from gold. But that's not what's driving price right now. Industrial demand doesn't explain a parabolic move in a compressed time frame. Industrial demand does not explain why silver is outperforming every major tech stock index on a percentage basis over the last 6 months. What's driving silver is something the mainstream won't discuss honestly. Collapsing confidence in the monetary system, its ability to maintain purchasing power. We're 15 years into an experiment in money printing that has no historical precedent. The Federal Reserve's balance sheet went from under $900 billion before the financial crisis to nearly $9 trillion at its peak. The European Central Bank, the Bank of Japan, the People's Bank of China, all of them expanded their balance sheets by multiples. We created more base money in 15 years than in the previous century combined. The conventional economic model said this should have created massive consumer price inflation immediately. When it didn't, when the CPI stayed relatively tame through most of the 2010s, the central bankers declared victory. They discovered the secret. You can print unlimited money as long as it stays in the financial system, inflating asset prices instead of consumer goods. It was a brilliant solution for the asset-owning class. Stocks and real estate soared, making the wealthy dramatically wealthier, while official inflation metrics stayed low enough to avoid political backlash. But that money didn't disappear. It's still in the system, sloshing around, creating imbalances. And over the last 5 years, it started leaking into consumer prices in ways that couldn't be ignored or explained away. Not just the post-pandemic spike that they tried to call transitory, but persistent elevation in the cost of everything that matters. Food, energy, housing, healthcare, education, the things you can't substitute away from or hedonic adjust into meaningless statistics. Here's why that matters. When inflation becomes embedded, when people start making decisions based on the expectation that money will be worth less tomorrow than today, the entire incentive structure of the economy changes. The preference for holding cash disappears. The willingness to lend long-term at fixed rates evaporates. The trust in government promises about fiscal responsibility and monetary stability breaks down. And most importantly, the relative attractiveness of assets that can't be printed, diluted, or politically manipulated increases dramatically. Tech stocks are pure financial abstraction. They're valued on discounted cash flows that assume stable currencies, functioning legal systems, and continuation of the current regulatory and technological environment. A share of a software company is a bet that the future will look fundamentally like the present, just more digitized, more connected, more algorithm-driven. That bet has worked spectacularly for 2 decades because the conditions that favor it have been artificially maintained by central bank intervention. Silver is physical reality. It's an element with specific properties that humans have valued for thousands of years. It conducts electricity better than any other metal. It has antibacterial properties. It's rare enough to be valuable, but not so rare as to be impractical for exchange. And critically, its supply is constrained by geology and mining economics in ways that can't be overcome by monetary policy or financial engineering. The market is starting to recognize that these 2 categories of assets are going to perform very differently in the environment we're entering. Tech stocks need stability, low rates, predictable growth, continuation of globalized supply chains, and most of all, confidence in the dollar's purchasing power. Silver thrives when those assumptions break down. This is the moment where we are seeing the early stage of capital recognizing that the promises underpinning financial assets might not be as reliable as advertised. It's not about tech companies being bad businesses. Many of them are phenomenal businesses with real revenues, real products, real competitive advantages. But their valuations are built on a monetary system that's showing signs of terminal stress. Look at what happened in early 2025 when the Fed tried to maintain its higher for longer stance while simultaneously managing a banking crisis in the regional sector. They had to choose between controlling inflation and preventing financial contagion. They chose preventing contagion, just like everyone paying attention knew they would. They always choose preventing contagion. They have to because the entire system is leveraged to a point where any sustained stress creates cascading failures. But each time they make that choice, each time they prioritize system stability over currency stability, they damage the long-term credibility of the dollar. The market starts gaming out the end game. If the Fed will always print rather than allow deflation, if they'll always backstop the financial system regardless of the inflation consequences, then holding dollars becomes a losing proposition over any meaningful time frame. And if holding dollars is a losing proposition, then dollar-denominated financial assets need to be evaluated differently. Silver at $79 is the market's way of pricing in that realization. It's not the end of the move, it's the beginning. Because once this dynamic starts, once the preference for physical over financial takes hold, it becomes self-reinforcing. Rising commodity prices create more inflation, which forces the Fed into an even more impossible position, which drives more capital into hard assets, which drives prices higher still. The tech sector is particularly vulnerable in this environment because it's been the primary beneficiary of the old regime. The companies with the highest valuations, the largest market caps, they're all trading at multiples that assume continued dollar stability and low real rates. If the 10-year Treasury yield goes to 6% or 7%, while inflation stays at 4% or 5%, suddenly those discounted cash flow models look very different. A company that looks reasonably valued at a 2% discount rate looks grotesquely overpriced at a 5% discount rate. Meanwhile, silver doesn't have a cash flow to discount. It doesn't have a PE ratio that needs to be justified. Its value comes from its properties and its scarcity, neither of which changes when interest rates move or inflation accelerates. If anything, higher nominal rates and higher inflation make physical assets more attractive because they highlight the instability of the financial system that's trying to manage those variables. Here's what the mainstream analysis misses entirely. They treat this as a rotation within asset classes, a tactical shift from growth to value or from financial to real assets. They think you can model it with factor exposures and correlation matrices, but what's actually happening is a phased transition in how markets perceive the durability of the current monetary regime. For 40 years, since Volcker broke inflation in the early 1980s, we've lived in a world where central banks had credibility. They could make promises about price stability, and people believed them. That credibility allowed the entire financialization of the economy, the explosion of derivatives, the growth of private equity, the dominance of software and services over manufacturing and commodities. You can only build that kind of economy on a foundation of monetary trust. Let me share a perspective that often gets overlooked. That trust is eroding, not because of some sudden crisis or policy mistake, but because the mathematics of debt accumulation have reached a point where there's no path forward that maintains the status quo. The debt to GDP ratios in every major economy are at levels that historically have only been resolved through default, inflation, or financial repression. Default is politically unacceptable. Financial repression requires a level of control that's difficult in modern markets. That leaves inflation as the path of least resistance. The problem is that controlled inflation is a fantasy. Once you cross certain thresholds, once expectations become unanchored, inflation develops its own momentum. The Fed knows this, which is why they're so terrified of letting it get started. But they've already lost that battle. The inflation is here, embedded in the system, and their only options are to either crash the economy to stamp it out, which would require interest rates and unemployment levels that are politically impossible, or accept it and manage the transition. This changes everything. Tech stocks are denominated in dollars. Their earnings are in dollars. Their valuations assume dollar stability. When the dollar itself becomes suspect, when people start questioning whether a dollar next year will buy what a dollar buys today, every assumption in equity valuation needs to be re-examined. The companies might be fine. The businesses might be thriving. But if the measuring stick itself is unstable, then measuring stick assets perform poorly. Silver is priced in dollars, but its value doesn't come from dollars. It has value in every currency, in every economic system, in every regime. That's what makes it a monetary metal rather than just an industrial commodity. Throughout history, when currency systems destabilize, capital flows into assets with that characteristic. Not because of some mystical property, but because humans need ways to store value across time, and when government promises become unreliable, physical scarcity becomes the most trustworthy alternative. The ratio between tech stocks and silver is going to be one of the defining charts of the next decade. Right now, that ratio is still at levels that reflect the old paradigm where financial assets dominated and commodities were afterthoughts. As that ratio compresses, as silver gains relative to tech, it will mark the transition from the financialized economy of the last 40 years to whatever comes next. What this all comes down to is we're living through the endgame of the post-1971 fiat currency experiment. Nixon closed the gold window in August 1971, severing the last connection between the dollar and physical metal. For 50-plus years, the system worked because the United States had the economic and military power to enforce dollar dominance globally, and because the Fed maintained enough credibility to keep inflation expectations anchored. Both of those conditions are deteriorating. American economic dominance is being challenged in ways that were unthinkable 20 years ago. The petrodollar system is fragmenting as major energy producers diversify their reserve holdings and settle trades in alternative currencies. And the Fed's credibility has been damaged by a decade of experimental policies that have created obvious asset bubbles and wealth inequality while failing to generate broadly shared economic growth. Silver hitting $79 is a symptom of these deeper structural shifts. It is the market's way of expressing doubt about the sustainability of dollar hegemony and the financial system built on top of it. The move higher in silver prices isn't a bubble or a speculative mania driven by retail momentum. It's a repricing of monetary risk by sophisticated capital that can see the writing on the wall. Tech stocks, for all their genuine innovation and business quality, are on the wrong side of this shift. They're assets whose valuations depend on the continuation of the current system. They need low real rates, stable currencies, globalized markets, and cheap energy. They need the Fed to keep the music playing. Silver doesn't need any of those things. It maintains value regardless of what happens to interest rates, currencies, or geopolitical arrangements. The exposure of dollar limits is happening in real time in the foreign exchange markets, in the treasury market, in the commodity markets. You can see it in the de-dollarization efforts across Asia, Latin America, and the Middle East. You can see it in central banks accumulating gold reserves at the fastest pace in decades. You can see it in the persistent inflation that refuses to return to the Fed's 2% target despite aggressive rate hikes. Every one of these signals points to the same conclusion. The monetary regime that made tech stocks the dominant investment for 2 decades is breaking down, and the regime that's replacing it will favor hard assets, tangible production, and physical scarcity over financial engineering and digital abstraction. The investment implications are profound. A portfolio constructed for the 2010s, heavy on growth stocks and tech dominance, light on commodities and hard assets, is a portfolio built for a world that no longer exists. The rebalancing isn't about getting bearish on technology as a secular trend. Technology will continue advancing, companies will continue innovating, the digital transformation of the economy will continue. But the valuations being assigned to those companies need to reflect monetary reality rather than central bank fantasy. Silver at $79 is telling you that monetary reality is reasserting itself. The artificial suppression of commodity prices through financial manipulation and narrative control is ending because the underlying fundamentals can't be suppressed forever. Supply and demand eventually matter. Physical constraints eventually bind. And when you have spent 15 years incentivizing underinvestment in commodity production while simultaneously printing trillions of currency units, you create exactly the supply-demand imbalance we're seeing now. The smart money isn't waiting for the mainstream media to explain this transition. They're not waiting for Wall Street strategists to update their models. They're watching what's happening in the metals markets, in the energy markets, in the agricultural markets, and they're repositioning accordingly. The flow of capital out of extended financial assets and into undervalued physical assets is still in its early stages, which means the opportunity is still available for those paying attention. But the window is closing. Once this trend becomes obvious, once it makes the cover of financial magazines and gets discussed on mainstream television, the easy gains will be gone. Silver at $79 is already a substantial move from the 20 levels we saw just a few years ago. But if the monetary transition thesis is correct, if we're genuinely watching the breakdown of the post-Bretton Woods currency system, then $79 will look like the beginning rather than the end. The tech sector will have to adapt to this new reality. The companies that survive and thrive will be those with genuine pricing power, real competitive moats, and business models that work in an inflationary environment. The financial engineering plays the companies valued on hope and narrative rather than cash flow and tangible assets. Those are the ones that will get destroyed as the cost of capital reprices to reflect actual risk rather than Fed-manipulated rates. Silver's message is clear. The old rules are changing, the old assumptions are breaking, and the old hierarchy of financial assets over physical assets is inverting. What matters now is recognizing that message before the broader market does, and positioning accordingly before the transition accelerates. The limits of the dollar aren't theoretical anymore. They're being exposed in real time in market prices, in capital flows, and the very real premium that physical assets are commanding over financial promises. This is what regime change looks like in markets. Not a sudden crash or obvious crisis, but a steady grinding shift in what works and what doesn't, in what gets rewarded and what gets punished. Silver at $79 is the marker telling you that shift is underway. The question is whether you're positioned for the world that is coming or still holding on to the world that is ending.